Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. This episode features Ryan O'Connor of Crossroads Capital. If you have been fortunate enough to talk to Ryan, you will know that he is very well thought out and also can carry a conversation. So strap in and enjoy the ride on this one. I think it's a solid pod is my host review. So I hope you grab yourself a cup of coffee and enjoy listening. This episode is sponsored by Daloopa. Daloopa not only has the world's longest ad read, but is also a fantastic partner, and they are my spreadsheet of choice when I am looking to get up to speed on a company or an industry. You can click through any cell and it takes you directly to the source. I find it to be incredibly valuable. I will read their official copy. You may need to refill the coffee after this one. I kid, Daloopa. I love you guys, but this is a long read. Anyway, Daloopa is founded by a former hedge fund analyst to bring simplicity into the investment process. Daloopa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. Daloopa scales the velocity of an investment team's idea gen. Analysts spend less time locating and manually inputting meaningful disclosures into Excel and more time synthesizing in the minutes after the print. Bang! You could have been synthesizing that Google was going to sync on that print. Anyway, that's not actually in this copy. Back to the copy. Daloopa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Daloopa's data sheets include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Daloopa's Excel plugin can also update your existing models for the latest quarter in just a single click. One click, folks. Bulge bracket banks and major multi-managers are trusting Daloopa for use in initiating coverage, building and maintaining industry dashboards, and keeping their models up to date. Visit daloopa.com/Business Brew to create a free account and learn more about how Daloopa can help increase your team's speed to differentiated insight. I'm telling you, that is a read, but it is a heck of a product. It's a heck of a team. I like those people over there. They've been very kind to me. And I think that if you are looking for something that can save your team a lot of time and you value the accuracy and the ability to trace data to a source, it's worth giving Daloopa a spin. So check it out. Anyway, as always, nothing in this show is investment advice. All of the information in this program is for entertainment purposes only. Please consult your financial advisor before making investment decisions and do your own due diligence. On to the show. Have a good week, folks. The one and only Ryan O'Connor. What's happening, man?
What's going on, brother?
Not much. We have gone through technical difficulties to get to cross the Rubicon of recording. I am excited about that. It was almost a problem.
Story of my life.
Well, the story of mine as well. A slightly better setup than another podcast that I have been known to be on occasionally, but it's okay. Whatever.
Mm-hmm.
So what's good, man? What's going on with you?
Nothing. Same old. Trying to build the fund. Just got back from a long trip to Japan. Which was
what does your trip to Japan entail? What does this look like when you go to Japan?
There was a lot of things. This time we went to go meet with a bunch of Japanese corporates in the gaming space to try and confirm a couple hunches in a few different ways. Primarily, this trip was focused around the Tokyo Game Show and trying to get developers to give us insights into not just kind of the larger space, but, Japan as a country and the culture in general, and kind of use that to leverage on our behalf for our Nintendo SPV. So there were a lot of very kind of enlightening things of, getting in the ground and talking with a lot of them. But I'll give you one example. And it's funny, you saw this in the news yesterday, I believe, with the government basically coming out as part of its corporate reforms. And, in this specific case, it was, relating to compliance amongst various firms listed on the Tokyo Prime Exchange. There's no other way to say it. other than that they're basically entertaining shame tactics by naming names of who's not compliant.
So can you take a step back and just like for people that haven't followed what's gone on with Japan, what was it, 18 months ago or so? There was like a real push. Like you mentioned the Prime Exchange. There's a number of exchanges now, right? And you're kind of like relegated to a lesser exchange if you're not demonstrating some sort of shareholder focus. Is that a fair way to characterize what's going on?
Yes. The difference, though, between so many of the reforms in the past and kind of what began approximately 18 months ago is, I think for the first time ever, Japan has put real teeth into these reforms, not only, from a high level government perspective, but I would say in particular, like, for example, the court systems are on board. And I think this is largely in reaction or, as far as the question is what's changed, it's really, a matter of necessity. I mean, given the demographic implosion going on in the place, like if they don't improve corporate productivity and do what they need to do to make Japan a attractive place to invest for, foreign direct investment and the like, they're going to be in real kind of existential trouble. And so this, kind of round of changes is kind of revolutionary in the sense that not only are there big repercussions, with respect to things, matters as it relates to corporate governance and capital allocation in general, there's real, like I said before, teeth to it where they are basically forcing compliance or you get delisted. And that's happening in a variety of ways. But one of the things we constantly heard when, meeting with corporates, and we met with a few other hedge fund managers in Japan while we were there as well, was, related to, kind of like, I don't know how to say it, but like the Japanese hive mind and how important a reputation and community is and how that drives behavior. For example, when we were sitting with one manager, he had talked about how there was a company that they were invested in. And you have to think about being a CEO or a C-suite executive in Japan. It's not so much your pay in a kind of in a vacuum that drives decision-making there. It's more the perks that come with being a CEO, having a driver, being the big man in charge. And so part of the pressure, and, this is kind of a secular tailwind that has kind of inverted recently, and I think we're in the very early stages of it, but most Japanese corporate C-suite executives are much more concerned with being out of touch or out of alignment with what everyone else is doing. And so one of the things, in this particular example, they were talking about, they had run a proxy and they had expected this company to do a very large buyback somewhere in, proportion to what its largest competitor has done. So they came out with their annual, or not, I'm not sure if it was their annual report, but their quarterly report, and they announced their plans to do so. But it was very disappointing, at least in terms of order of magnitude relative to what these investors were expecting, and more importantly, what their peer or their largest competitor had done. And so the stock dropped 20%. The proxy was coming up, and basically they reversed course and decided to up the buyback approximately in line with the competitor there. And the manager was essentially talking about how a lot of the biggest fears, relating to these executives is kind of not being in touch with what everyone else is doing. And so getting them to kind of see the light, for better or worse, was ultimately a function of what their peers were doing and the fact that if they don't match that, the chance that they get kicked out or replaced goes up exponentially. So, you think about the prior 30 years, it was kind of the opposite, right? Why would, a company start buying back and, stock and
yeah, it's like a cultural shift here. Yes. Where now if you're not returning capital to shareholders, you're getting a little shamed as opposed to growing cash on the balance sheet.
Exactly. And so it's a very subtle thing, but I think it's a lot of what we do is, you can call it inflection investing, but our focus is really on businesses undergoing value unlocking change in, both at the micro and call it the macro level. When it comes to investing in Japan in particular, for the first time in decades, employing Western government practices around disclosure, around capital allocation, and the like, instead of being, kind of the uncool, contrarian, unorthodox. You kind of have to be a maverick in that respect, or at least you would have had to have been in the last 3 or 4 decades. That's actually starting to reverse, and the momentum behind this change is accelerating. And you see that with there was I don't know if it was an FT article, but the other day they basically reported on how the government is resorting to shame tactics to get people on board and to kind of start doing the right thing so Japan can start to benefit from foreign investment, which has essentially fleed the country relentlessly for decades. So
why now? Like, I remember we were talking about this at Berkshire, which, as background for people that don't know, you may have read what you might think is a Google short paper, but it's not a Google short paper, and you will learn why. But I pinged Ryan after reading that paper, and he was like, dude, we had dinner at Berkshire. And I was like, oh, thank God it's you on the other end of this. I would love to have you on the pod. And you said, well, I would love to come on the pod. And then we've had fantastic conversations in between. So I'm very, very happy that that paper came out and that I read it, because we kind of like lost touch. And we were talking about this for like that night. And I know Dan had been talking to me for a while about this, and I'm not 100% clear on the why now, other than the pain point has just kind of hit this threshold where it's time to change.
Yes.
But was there a catalyst behind that, or is it just time festering a wound that just needs to be healed or something?
Yeah, I think it was the kind of relentless capital outflows. It's semi-incredible, but when you normalize, for example, returns on capital as opposed to looking at valuations or looking at returns on equity, on a return on capital basis, Japan's corporations as a whole have essentially reached parity with the United States. Now the ROE looks a lot lower because of kind of the ludicrously large balance sheet, cash on the balance sheet and the like,
and they haven't shrunk the denominator as much, right?
Yes. And so it's the cheapest it's ever been, and far and away the cheapest developed nation in the world. And so, I think fundamentally speaking, there's a huge reason to invest in Japan, kind of just based on valuation alone. And the fact that it's trading at, I saw a Big Mac, based on the Big Mac index, you have basically Japan is cheaper than a wide swath of called, Southern Asian countries that are closer to, we'll say, developing markets than developed. So
now, is this a I understand that there's the corporate governance side of it. If I wanted to take the devil's advocate side of this argument, would I say, well, it's a demographics and a lack of growth issue?
Yes.
Okay.
Yes. And if you look at the demographics, time is fastly running out. One of the things that someone told me while we were there was something like a third or more of the country right now is 65 or older.
Jeez.
Yeah. So they got to do something. Otherwise, I don't know, China's just going to move in to, kind of revitalize, not only the country's capital markets and capital invested in the nation, but also to attract immigration and to fill that plug. Because other than, if they don't do something and they don't do it now, it's going to be a huge problem, and sooner than I think most people expect. So I think their decision to enact these reforms and to do it with real teeth was a kind of a brilliant move by the government and the Japanese people. And it's going to take time for the general narrative, the cultural reality in Japan to fully shift more towards a Western point of view. But I don't know. Initially, when you look at, you see KKR, let's see here. Buffett, Steve Cohen, I could go on and on.
Ryan O'Connor.
Yeah. I wouldn't put myself in those categories, but, when all of these brilliant investors are all moving to Japan in size, establishing family, wings of their family offices there. But, really kind of diving deep, I think you should, at least from my perspective, it's like it's time to pay attention. And I think, like a lot of things, whether it's, say Nintendo in particular, the kind of narrative that just won't die despite it being kind of objectively ludicrous at this point in its business model transformation, that it's a hit-driven cyclical. I think it takes a fair amount of time for, narratively speaking, for people to wake up and realize that not only is Japan serious about kind of getting rid of all of the insular kind of protectionist measures, like the share cross holdings that were put in place over decades as a protectionist measure.
Okay, so what are these? Because I think it ties into your Nintendo thesis, unless I'm completely off base.
No, it does. I mean, in the sense that a lot of Japanese corporates, so for example, Nintendo owns a lot of the stock in banks, particularly the Bank of Kyoto, and they own stock in Nintendo. And Nintendo owns stocks in a lot of its kind of key partners like Bandai Namco or Square Enix is, another example. But part of the reason this was done, and ostensibly, a lot of it is still maintained because of kind of call it strategic tie-ups, which, makes sense. And on that basis, I have, no problem with those shares kind of continuing to be held. But at the end of the day, for example, Bank of Kyoto is an interesting example. So this was a while ago, but, I was kind of looking through various Japanese small caps. And in a new deck from the Bank of Kyoto, they basically line up, kind of spoon feed it to you, which, kind of shocked me. But they had all of these equity holdings on their kind of marked at book or cost, if you will, when it comes to their book value. And a lot of these equity holdings were established decades ago. I mean, one anomaly, one kind of broad analogy, would be something like Sears or something that had bought its real estate and booked it at cost, in many cases, 5-7 decades ago, if not before that. And so its carrying value has basically no reflection whatsoever on its current value. If they were to liquidate those shares today, they would be done at a huge premium to where they were marked. Well, Bank of Kyoto was trading at, let's call it was something like 6 or 7 times depressed book value, tangible book value, but they came out with a presentation that basically spoon-fed you that, for example, their equities that were held were basically in aggregate worth more than the entire book value of the company. So in unwinding these cross holdings, tangible book value basically explodes higher because it was masked based on the accounting conventions that had been used historically. And last I checked, it was still trading at a big discount to the value that was going to be unlocked from, monetizing those equity holdings. It creates kind of call it a compound margin of safety or a double layer of safety as they unwind their cross holdings and start to invest productively and their ROE increases. You should go from, not only a depressed multiple of book value, but, something close to a premium or, book value plus, if you want to put it that way. But so that is a kind of a very simple kind of average explanation of how unwinding cross holdings and kind of cleaning up their cap structures and, all of this stuff should provide considerable torque to Japanese equities in general. With Nintendo, I think the issue, or at least the hidden value there, is all about the Pokémon company and the fact that it's truly, like, we can get into all the details related to this, but I think they have at an absolute minimum a 50% look-through economic stake in the Pokémon company. I actually think odds are, their true ownership is much higher. Obviously, they own the patents and the trademarks, but, there's no doubt that Nintendo controls the company, but it's valued at zero on the balance sheet. And so when you think about it kind of high level, I mean, I think this might come off as hyperbole, but I think Nintendo owns what is arguably, if not the most valuable hidden asset in the world. Is certainly, I don't know about ever, but, I've never seen anything quite like it. And this gets into a whole kind of rabbit's hole of getting into Japanese accounting metrics. But, just as one thought off the top of my head, would you believe that in Japan, if you're a private company and you own 100% of a subsidiary, so it's not like it's non-consolidated or anything like that, but you do not have to report the associated revenue and income from that subsidiary, which I don't know about you, but that makes my head explode thinking about why they could get away with not reporting, the revenue and cash flow of subsidiaries that they own 100% of.
Well, they do have to report the cash that comes into them, like in the form of a dividend, correct?
Oh, so I mean, no.
If no, then that's interesting. Wow.
Yes, no, they don't.
Huh.
So, and I'll give you an example of just how, there are public financials or people that usually tout around, what they have released. And so just to give you an idea of how ludicrous they are.
Wait, okay, hang on. Just humor me for a minute.
Sure.
Pokémon Go is released. Nintendo owns arguably 50% of that business. It shows none of the revenues, none of the costs. Where in America, it would show all of the revenues and all the costs. It would be consolidated.
Yes.
And on top of that, if there's a dividend paid from the Pokemon company to Nintendo, I mean, I guess that it would probably be in the cash flow statement, right? I mean, otherwise you couldn't reconcile the cash.
Well, so what you get with, the Pokemon company, so basically the way it works is Nintendo gets all of the, call it rest of the world sales on Pokemon video games flow through Nintendo's financials.
Okay.
But 30%, i.e. all of the Pokemon software sold in Japan, is the Pokemon companies, which is not in Nintendo's financials, nor is, their sprawling web of joint ventures, their ownership of the Pokémon centers, which are ludicrously successful, kind of restaurants where you have to, last I checked, it was like, I think in Tokyo it was like an 8-month delay by the time, before you could actually get a seat to eat in one of them. I mean, if just that part of it was traded in the United States, it'd probably be worth $500 million in public markets. You have JVs and other video game companies. The digger you deep, the kind of more mind-blowing it goes. But the only thing that is reported publicly with respect to TPC, which I'm just going to call the Pokemon company for short, is, they basically have released, and I think this is in part because they're forced to, because of global licensing data that, allows one to kind of triangulate essentially what they earn. But so in those financials, if you go back, I think they've started to, their net income shown has started to grow a little bit larger in the last year and a half, 2 years. But over the prior 20 years before that, I think they had shown something like 500 or 600 in net income in total over that 20-year period. Well,
500 or 600 what, million?
Yes, correct.
Okay.
Okay. So now let's just think about this through a basic smell test. So what we know is that, because it's the most valuable entertainment franchise in the world, at least based on, kind of gross sales, and you look at their merchandise licensing revenue. So, they've done about, give or take, $100 billion over the prior 20 years in gross merchandise sales. So the average royalty from talking to, people that used to work with Pokemon and, a variety of sources usually is, call it 10% of whatever they sell. So, if you're thinking about top line revenue, just from merchandising sales alone, you're looking at, let's just call it, to be simple, $10 billion in revenue. Now, I don't know a merchandise licensor in the world that is successful on any kind of level that doesn't have operating margins of, let's call it 50% in the ballpark. I think that's a fair approximation. So, what are we talking about here? That's $5 billion in operating cash flow, just basic sanity test that the Pokemon company should have earned over the prior 20 years. And, divide that by 20. And essentially they should have made, just from merchandise licensing, in and of itself, $500 million a year, every year for the last 20. And yet, over that prior 20-year period, they're reporting that.
Wait, hang on. Walk me through this math again. You said $5 billion, right?
Yes. So divide $5 billion by, here, I'll do it with you.
Yeah. We got 5 billion by 20 years. You got 250 million a year.
Right. So,
and then we're talking like a 50% operating margin.
Well, so that is the margin.
Okay.
250 million in operating cash flow each year for 20 years. So,
Okay.
Nintendo, or excuse me, TPC in the, financials that people point to prior to, I think it was last year, if you were to go back the previous 20 years, had made something in the line of, let's call it 600 million in total over those prior 20 years. So this is ludicrously preposterous on its face. Like, this is clearly not the correct numbers. And then the question becomes, how can that be? And I think one of the big answers is because they are not required as a private company to consolidate any of their sprawling interests, into reported numbers, at least reported numbers publicly. I mean, so, it doesn't pass the smell test based on the merchandise licensing that we know is approximately correct over the prior 20 years. It includes no value to the cash cow that is the software revenue and profit they earn year in, year out from Pokémon games. It includes no value for their joint ventures and various video game devs and whatnot. It includes no value from TPC, its restaurants. I mean, it's quite the rabbit hole as you start to go down it.
So what does that look like for you? Like, how do you start to go down this rabbit hole? Like, were you interested in Nintendo because you like games and you started to look into this and you thought to yourself, holy crap, there's like a ton of hidden assets here? Or like, how did you start to unpack something this opaque?
So, it was really kind of a byproduct of the diligence process, at least diving into the balance sheet side of it. I mean, for one example, as I'm going through, one of their subsidiaries was called the Entertainment Company of America or something along those lines. And you dig a little deeper and you realize, oh my God, that's their stake in the Seattle Mariners. But I should be clear that from the beginning, the investment thesis with Nintendo was always about the underlying transformation of its business model. And, all of the kind of hidden assets and, the balance sheet stuff was always kind of a free option in terms of eventually it getting unlocked. But as I dug in and a lot of the dots started to connect in terms of the transformation of its business and the implications of that, that was what, was kind of like the insight or call it the grand epiphany that got me, basically started me down a road where I just lived and breathed Nintendo for months. But, as part of that process, you start to dig into the balance sheet. And what I found there, particularly relating to the Pokémon company, was something that I just, it wasn't a part of the initial kind of series of things that made me dive in initially. But, the more I sat and thought and reflected about it and, kept digging, the more I realized that, if there could be some way to unlock this value, or let's just keep it simple, just create price discovery, what an incredible free option that is. I mean, me and a lot of my friends, we joke when it comes to the kind of massive optionality embedded in Nintendo as free option number 4,624, because, they're just so numerous. There's so many ways to win here. It's kind of silly.
I'm going to double click that to use the terminology, because one of the things that you and I talked about when we were on the phone was you mentioned what '08 did to you. And I know that you're talking about free options on the upside, but what you said to me was that '08 made you extremely downside focused and very cautious. And I'd love for you to just kind of take a quick tangent and talk about what that period did to you as an investor and why you are so downside focused, because I personally think it's interesting that Nintendo has grabbed you like it has, and you perceive there to be the upside that you perceive there to be, and yet you're also so downside focused. Like, it's the combination of those that I think is very unique here.
Yeah, well, I mean, I think to put it simply, that is absolutely what makes Nintendo in particular one of the most incredible mispricings, especially in context of its qualitative attributes that I'd ever seen. And, related to this, we're concentrated investors. This is a 25% position for us. And one of the angles, of running a concentrated book is it makes the thought of, fundamental risk or downside, extraordinarily unattractive. I can't tell you how many funds that have run very concentrated that letting up their discipline on the qualitative side or the downside protection side that basically undoes them. And so to get to your specific point, one of the things that was above all the most formative thing that has ever happened to me in my investment career, and I honestly can't even conceive of me being the investor I am today without it, was, basically coming of age in the financial crisis. And what I mean by that is, going into it, I had already kind of fallen in love with investing. I remember right around this time, my boss coming in and seeing me read "You Could Be a Stock Market Genius" and throwing it in the trash. And he did it for the best of reasons, but he was basically like, you're not running money. There are better times to do this.
So wait, so what was he saying? He's like, that green black guy is a has-been. This book is garbage. No one's going to know about that guy in 10 years.
He was more like, you should be focused on other things, versus, this kind of thing. But, the point is, by this point, I think I was, a pretty good analyst. But, frankly, I had no idea the, shifting sand beneath our feet when it came to the leverage in the system. So many elements of what happened in 2008, call it summer of 2007, I really had no underlying comprehension of. And so when the financial crisis happened, and while I think I would have done a little bit better than, say, the S&P, at the end of the day, it split my mind. There were a variety of things. I remember one of the first stocks that I found very early, that right out of college, was Brookfield Asset Management. And, this is me I'm just going to use simple numbers here, but I invested in 2003 and 2004. And so, fast forward 3 years later, and it's done spectacularly. I think we'll call it NAV is $40 to $45 a share. This is one of the highest quality companies, on the planet. And with one of the most impressive track records, forward looking, had a long runway of, high return reinvestment, but the bottom line was a very high quality company. And if you would have told me that Brookfield could trade, its NAV would be 40 and it could trade to 6, I couldn't conceive of something like that happening. And so that's just one example of a successive series of things that happened where it taught me that whatever price and value is, when things break, anything can happen. And that ended up kind of searing risk aversion into my soul in a way that I guess just fundamentally changed me. And I go back and you hear about Graham, for example, heading into the Depression and basically losing his shirt, and how that was the impetus, or, call it the origin story, that created the discipline of value investing, i.e., from Graham's perspective, he wanted to know, was there a kind of a systematic strategy or a way to have invested in 1929 where you would have preserved capital, or better yet, actually made money through this kind of, unprecedented disaster. And that's where you get, the net working capital, strategy. Literally, in a very meaningful way, value investing was born because of the experience that Graham went through with the, Great Depression. And in a lot of ways, that's what I needed myself to, one, to know that I know nothing, two, to, check your downside 10,000 ways from other, in 10,000 different ways, kill the idea constantly. But it just changed me in a way that I think if I'm very, very lucky for, because going through that type of thing, you realize anything can happen in the short term. And you should, while you can't predict the future, you can prepare. And so when it comes to Nintendo, we'd never taken a position at cost, I think, larger than 12% prior to this. But it was that just uncanny, almost unreal combination of highly predictable, visible upside, given, how most of the underlying earnings engines that are transforming Nintendo's business model are highly predictable. Looking out, if you're thinking about medium-term earnings, earnings power 2 to 3 years from today, you have that in spades. And for what we do, predictability is an incredibly important part of our process. On the other hand, not only would the transformation of its business take it from kind of a hit-driven cyclical to something closer to, call it a secular growth juggernaut, there is the downside protection element, which is, call it 10 to 15 billion in cash, and then all of the various hidden assets on its balance sheet that in combination are almost worth, what I would say is, including the Pokémon company, the entire current enterprise value of the business today. And so when you're concentrated, let's just put it this way, you need something that is kind of the perfect balance of value and growth. I mean, I think pulling those two apart is not really doable. I mean, growth is a component of value. But, for this purpose, it was just, not only were there multiple ways to win, but thinking about any realistic future scenario where one could permanently lose money, given the cumulative weight of their earnings power and asset value, is about as close to impossible as it gets. I mean, you look at their cash balance, it's diversified across currencies. Nintendo's kind of a natural hedge against currency inflation or deflation in Japan, given, the majority of its business comes from the rest of the world outside of Japan. But a lot of things about it make it this very unique combination of both incredible downside protection and very predictable upside based on, a business model transformation that I think we're kind of in the middle of, but a lot of the most important things that should permanently shift not only the narrative, but, the multiple. And, to be clear, Nintendo doesn't need any multiple expansion to do extraordinarily well going forward. But I don't think, the hit-driven cyclical narrative can be credibly denied past the point of the Switch 2, which I think is kind of imminent, and we can dig into that later. But
so when you're coming up with this thesis, what is it? Some of the parts analysis are often, it seems, not realized, right? So to what extent does Japan's change in corporate culture enhance kind of your, I guess, you know what I'm saying? Like give you comfort in the fact that this may actually get realized as opposed to just being a bunch of assets that are sort of trapped as they were for the last however many years.
Yeah.
Unless my characterization is wrong. I'm not,
So both things are true in that the downside protection from, the asset value and all of that or the hidden assets is real. And, when I think about conceptually the downside, I absolutely include them in that analysis. Now, when it comes to, thinking through the price targets and where the business should trade, I assume they're all worth zero. And, you can really hard, especially given their incremental changes in their own evolution with respect to capital allocation and capital returns. They've bought back roughly, I think, 11% of their shares over the last 10 years. And I think post-Switch 2, you're going to start to see them shrink the float rapidly because, the cash is piling up so fast, they don't have any other use for it. Let's just put it that way. So what you're talking about comes in, I think, is important in a couple ways, not essential to the thesis, but, certainly a nice, call it another free option is in many ways, Nintendo is the best of corporate Japan, we call it its national champion. And when you are in that position and, the entire country, the government, is for society's sake, and this is important to think about it from a local Japanese perspective, being in alignment with what the culture and, the government, the court systems, this kind of big push to reverse the policies of the past towards something approximating Western corporate governance standards, that I think Nintendo's the natural standard bearer of that flag, and I think that if Nintendo, doesn't follow suit, and in fact, I think they've been very early in kind of leading this charge, but, they have, call it emotional or cultural reasons to be the standard bearer of this kind of new era of corporate government that, is not necessarily, doesn't sit on the shoulders of lesser kind of Japanese corporates that aren't so synonymous with Japan and corporate business as a whole. So, I think it's a tailwind. I think it's an attractive tailwind. Do we really need that for the stock to be a home run for me or not at all? but it is a nice thing in the grand scheme of things to have everything moving your way in that regard.
Yeah, that makes sense. It's interesting because, it appears from the outside looking in to be such a change that I guess it's going to be interesting to see whether or not the entire country can collectively change its behavior. And that would be a really neat societal sort of a experiment to watch, or will be. It won't, it's not even a maybe. It's going on.
Well, I mean, you kind of hit the nail on the head of why we wanted to be on the ground, because you can palpably feel it, especially we met with Bondi, we met with Square Enix, a variety of the publisher of Elden Ring, a lot of these Japanese corporates. This is very much on the top of their mind. Now, it's Japan, so whatever you think, this value unlocking change would take place here in, the West, just, as a general rule, assume it's going to take 5 times
Add
longer.
A few years. Yeah.
But, the tanker is turning and moving in the right direction. And I think all of these cultural inflection points will accelerate as this turn starts to gain momentum. That, in another sense, they're kind of being forced to. I mean, that's part of the power of having the government and the court system so well aligned here, and why you've seen, firms like KKR and all of the beginning of all this, increasing foreign direct investment in the country, is because the government nor the court system is going to save these companies anymore. So if you're a PE, and, I think the KKR guys talked about how Japan reminds them of the US in the 50s and 60s towards the tail end of the conglomerate wave. I mean, just if I was king of capital allocation in Japan, I mean, it is absolutely mind-boggling the value you can create simply by just doing basic common sense things like buying back stock beneath book value and just productively using your resources to grow the value of the business. And through that, the value of the Japanese corporate sector in lockstep.
Now, when I pull up Nintendo, I look at it, and I might be wrong, but it looks like it trades at like roughly a 5% free cash flow yield. So what is it that I'm not seeing in my screener that you're seeing? And I know some of the answers, and maybe a lot of the answers, these hidden assets.
Yeah, so forget about the hidden assets for now. Let's just think of them as all worth zero. I think that makes it kind of easier. If you add in the cash, I think the free cash flow yield is better, or you back it out. So
yeah, you're right. Sorry.
Yeah.
You are definitely correct.
Yeah, it's 25% of the market cap. So on an EV to EBIT basis, it is, much cheaper.
Yeah, it's like 10 times ish trailing.
Yes.
Yeah.
There's a lot of ways you can think about how crazy cheap this is, but, just one quick one. I mean, the Microsoft Activision deal, this actually relates to the change ahead, just closed at $75 billion. And, to compare Activision's assets to Nintendo's, is ludicrous. Yet it just got bought out by Microsoft at, call it approximately twice what Nintendo trades at, despite Nintendo being, I think, hands down the premier, video game business in the industry, far and away the best IP. However you want to try and slice it, I think Nintendo is the crown jewel of the video game space. And in fact, in these recent leaks from the Microsoft trial, Phil Spencer himself basically makes exactly that point and talks about how, if somehow he could get Nintendo to cross the line and sell themselves, that it would be a career-defining moment. So this isn't necessarily a secret, but it just kind of, if you want to think of this from its strategic acquisition value, whether that's Microsoft or Disney or Apple, I think we're in the range of $250 billion, on the low end. So there's a kind of a quick blurb on the margin.
I think Comcast is a more logical landing place.
Well, that's also, given all of the various tie-ups with Universal, and that would definitely be there.
Yeah, you got animation competence, you got park competence, you got a CEO that's looking to transcend scale.
Yep. Well, when you think about it from the ability to monetize under-monetized IP, the only comparable to Disney is basically Comcast, i.e. Universal.
They're very good at what they do.
They are.
Very good at what they do.
They are. They're spectacular.
And I know they got partnerships with Nintendo, so just kind of makes sense. I mean, the recent movie was very good, I thought.
I mean, a sign of things to come. So, well, let me take a step back and kind of walk through, I'm trying to do it kind of three parts, but, Nintendo's past and basically the key to, well, let's call it the future. And I can walk through kind of our base estimates, but I'll walk through kind of the optionality.
Why don't we just keep it high level? And, if anybody wants to reach out to you, they can get your estimates and stuff. But
Sure.
I think keeping it like what you see in the future and why you think that maybe it's undergone this business transformation that is no longer sort of like a console-based hit-driven business would be helpful.
Sure. Okay. So let's talk about the things that are kind of not discounted in the stock price. And, what these forward-looking changes, most of which will come in part with the launch of the Switch 2, and, what each of these pieces is worth that are not included in that 10 times to EBIT figure that you just discussed. So the first one I'd say is mean reversion in its first-party software slate. So Nintendo obviously makes most of its money, at least historically speaking, through its first-party games. And if you're to look at the first 5 years of the Switch's life, you see that, they published on average, call it approximately 15 first-party games a year. Well, 2 years ago, I think they released four or five, and then last year, I believe it was 3. So basically, you have this massive drop-off in, call it normalized number of kind of hit games that Nintendo releases as a first party from 15 to 3. Well, the logic behind that, very simplistically speaking, is that Nintendo, I think, had initially planned to begin sitting on games about 8 to 12 months prior to the release of the Switch 2. And this makes kind of all the sense in the world for why, but it, kind of carpet bombing. As we stand today, we're kind of on the eve of the first major iterative upgrade of the Switch platform, and that is the Switch 2. And so by basically taking 8 to 12 months and kind of stockpiling all of these marquee game franchises to kind of carpet bomb into the first 24 months of the transition from the Switch or the OG Switch, Switch 1, whatever you want to call it, to the Switch 2 is, strategically very smart because it helps smooth out any transition between console changeovers. And Nintendo has, from the beginning of this business model transformation, consistently reiterated that stability between console changeovers is, basically 100% where we're focused on. Well, so, okay, why does this matter in terms of what's not kind of discounted in the price today? Well, so for example, when I released our latest quote unquote book on Nintendo, that was a little over a year ago, maybe closer to a year and a half ago at this point. The active user base or active playing users, which is a KPI that Apple uses and, is far and away, I think, the most important KPI when it comes to Nintendo's case, because what is it? It's the amount of people on your ecosystem or your platform that are buying and purchasing games. Well, shocker, when all of a sudden Nintendo's bread and butter, i.e. its first-party games, kind of falls through the floor in terms of the release slate, the tie ratio, which is, the average amount of games a active playing user will buy per year, fell through the floor and dropped from, call it an average of 3.5 for those first 5 years to 2, and I think it was 1.8 last year. I guess the point is initially it was planned to be an 8 to 12 month kind of lull in the software release slate. Well, because of a delay, and I can talk about the reasons why I think this delay happened, and the Switch was pushed into next year, you have that impact to its earnings from software. There's a double whammy here, in which I mean that this period of kind of lower software years was supposed to be 12 months. They pushed hardware out, which means they had to put, they couldn't release all the games that they had set up for the Switch 2. That created this double whammy effect where, in a period where the active user base grew from, I think when I released the letter, it was at 98 million. Today it's at 116 million. at least the last time they reported. I think by the time the Switch 2 is launched in April or May of next year, the active user base will be, call it 125 million plus. So we're talking nearly a 30 million delta in active users between when they started this period of their first-party software releases dropping to today. So this creates this massive kind of embedded operating leverage effect, where as the active base or active playing users continues to grow, and Nintendo starts to release or return to a normal software pipeline, that it had in the past or prior to, deciding to sit on these games, you have a multiplier effect that I don't think people appreciate whatsoever in terms of just the sheer magnitude of what that's going to look like. And I think in Q1, we got a preview of that with the release of Tears of the Kingdom. I mean, this was a game that I expected to do 20 million for the full year, and it ended up doing 18 million in basically a month, which, is somewhat mind-blowing. But this is important because this is the first major, call it first-party key franchise that Nintendo had released in roughly 2 years. So I think when you look at kind of the blowout numbers where they did 40% of the full year guide and operating profit in Q1, which, kind of says it all. But that's a preview of what's going to happen when they, start to release, call it 3 to 4 system sellers plus a Pokémon game every year going forward.
So I see fiscal year 23. I'm in the Daloopa machine here.
Okay.
I've got 429 million I'm looking at millions, not billions. Yeah. Of operating profit, and then 185 just here in Q1. Yeah.
So yeah, I believe 3.5 billion in operating profit was the full year guide. So they did, I'd have to pull up my numbers, but yeah, it's approximately 40% of the full year guide in a single quarter.
Wow. All right. I'll cut my comment that may or may not be right, but I sort of, okay. So when I'm looking, I'm just kind of looking at the numbers here, and what I feel like people are seeing optically is you've got user growth without commensurate sales growth. So the rebuttable presumption becomes, well, are these users getting less and less engaged, right? And what you're saying is that it's a lot more nuanced than that conclusion.
Yes. You have to understand what is driving the backward-looking numbers.
Yeah.
Kind of a key to what we do is, when I talk about inflection investing, I want to invest in situations where we not only have a material edge, but where the future and the past look incredibly different, if you will, and kind of leveraging those insights kind of for our own bottom line. And so in this case, you'd have to break down, especially with Nintendo's financials, look at software sales. The more incredible data point that I'd point to you is that Nintendo's business historically has been primarily driven by its games. The last 2 years, the amount of games it has released has dropped through the floor, in terms of games per year. Nonetheless, if you look at software sales, despite this incredibly depressive effect, which was compounded by the need to delay the release of the Switch 2, you have a scenario where, I think the far more remarkable thing is that software sales have remained flat despite the complete collapse of what most people would view as the primary driver of their earnings, i.e. the amount of games it released per year. Nonetheless, it has remained stable and stayed flat despite that. And so in doing so, it's kind of masked the hidden operating leverage when business gets back to usual and Nintendo starts to get back to releasing 15 titles a year along with its big system sellers versus, 5 and 3 the last 2 years. It shouldn't be a shocker that people that buy a system, I think engagement has remained strong because of NSO and other things. But, the fact that people buy less games when, a tiny fraction of the games that are normally released in any given year, I don't think that should surprise anyone. The more interesting question is what happens when Nintendo gets back to releasing, its regularly scheduled, software release schedule, for lack of a better term. Here's the basic math. So if you use the most conservative model that I put in the update, and you presume that as the release schedule begins to normalize and their big games, start getting, dropped with the release of the Switch 2. Well, actually, give me a second. Let's reverse it. So if we chalk up the 2.1 and the 1.8 tie ratios of the last 2 years to the collapse in first-party software releases related to the delays of the Switch 2, that implies that the tie ratio, again, the average number of games an active user tends to buy per year on the larger ecosystem, that the tie ratio reverts to where it was, when it was releasing 15 games a year, which was, call it the 3 to 3.5 tie ratio pre-pandemic. The impact to the equity value is pretty nuts. I mean, if I recall, I believe early in the Switch cycle, the tie ratio got above 4. And I actually think that's probably what's going to happen in the first year post the release of the Switch 2. But if we bump the tie to 3.25 games per year as the software release normalizes, and I'll get to the impact to the bottom line of, kind of a step change increase in third-party games that will now be released on the Switch 2 basically because of higher powered hardware. But just from the normalization in their first-party release schedule, that's going to add another, call it 1.5 to 2 billion in earnings through, call it fiscal to, or, I think this is calendar year 27, but that shows an increase of value by approximately 30 billion just based on that normalization alone. And so, we talked just now about its enterprise value today being 35 billion. And the fact that, a normalization in the tie ratio would basically create an incremental 30 billion in equity value. I mean, call me crazy, but I kind of think that says it all. Now, what's even more interesting on the software front is that historically, because of underpowered hardware, basically because, the Switch or the OG Switch is based on 2013 era cell phone tablet technology, most of the, call it marquee AAA third-party games that people love, think Madden football, FIFA, or now it's called FC in soccer or football, if for your, European audience, or games like Call of Duty. Basically, all of the biggest hits for all of the big multi-platform third-party games were not released on the Switch. The hardware wasn't strong enough.
Yeah, it was underpowered.
Yes, right, exactly.
Yeah.
So let's just do a couple, high-level math. So also think about this in relation to
Well, this is your theory of the App Store hiding in plain sight, right?
Correct.
Now you get to sell and take a cut of the distribution, and you don't have to worry about all the R&D and the development and the marketing of it and whatnot.
Yeah, it's pure. You basically have this inflection or explosion in pure margin or nearly pure margin incremental revenue, alongside the step change increase in some of the most popular games in the world that have, basically were not available. There are a few exceptions here and there, like The Witcher. There was a decent port, but by and large, some of the biggest and most important franchises in gaming were not on the Switch 1. And
that's a form factor that you can travel with pretty easily.
Absolutely. When we get into the competitive dynamics here going forward, it's actually far more interesting in what it means. But
because what you're basically doing is you're ending up competing with Xbox and PlayStation for people's time, right?
Correct. And
so why do you think they win that?
Well, because, how do you differentiate a platform in video games? I mean, nearly all games in general, kind of high level speaking, are, let me go through the math and a way to think through the impact to their, bottom line, and then we can kind of circle back. But all of a sudden...
But underlying this math, you have to assume that people are choosing to spend time on this Nintendo platform, which I don't think is, I believe, right? Because you're saying like they're going to buy the games from Nintendo's App Store.
Yes.
And I guess the question is...
why would someone, and this is actually a great point, because, a big part of the Switch 2 is that it was... Nintendo doesn't need raw graphical horsepower or any of these things to make great games. I mean, for them, it's about great gameplay and fun, and they could give two shits about photorealistic graphics and, all of that kind of thing. So
yeah, even the old school 2D games are fun, right? Yeah. It's not like a graphics issue.
I've had some of the old games. I have every bit as much fun playing today as, I did when I was 12. But, the whole point is Nintendo doesn't need raw, high-powered systems to knock it out of the park with great games and great gameplay. I mean,
or hasn't, right?
Yes,
Once you get into third-party stuff, you kind of do.
Yes, correct. So, a big part, and this gets into the lessons that Nintendo learned in a very hard way in the past with the debacle of the Wii U and how it was such a huge mistake to create hardware that basically can't be leveraged by third parties. And so one way to think about what the Switch 2 is doing, and this is not only to drive, platform stability and increase engagement, is to create higher powered hardware that is approximately in line with, the next gen systems are. And so this gets to your point of what's going to drive these game purchases. And more importantly, why would an Xbox or PlayStation user choose a Switch instead of, sticking with the PS5 or the Xbox Series X or S? And that's a great question. And it comes down to, I think, two things, because remember, this is the first time that Nintendo will be marketing towards, call it the hardcore gamer, the high-end gamer, gaming enthusiast, whatever you want to call it, since the GameCube in 2000. So it's literally been almost 25 years since they've tried to compete in terms of power with the other platforms. So what's the value proposition high level? And so if you think about that, let me put it this way. Say you want to be the Netflix of video game streaming in the future, and you want your platform to be differentiated versus the others. What's the one thing?
Is the answer here, hang on, is the answer here that you've got first party content that people want? So if you offer them hardware that is capable of driving the third party games, they're going to come to you because of your original content.
Yeah, because
for the most part,
because you can buy two systems that have.
Yeah, you're eliminating the need to buy two systems.
Well, yeah, I mean that in a big way, especially if the hardware is powerful enough to play current gen games with complete graphical and gameplay fidelity to the other systems. But at the end of the day is what does the platform not have? What does Sony and Microsoft not have and will not be able to get kind of high level? And that's Nintendo games. And so if you're thinking about a consumer value proposition standpoint, basically think about it like this. You can buy two systems that basically have the same games that the rest of them have. Or you can buy a third, which is Nintendo's, which will allow you to play all your favorite games in true fidelity to their intended gameplay that you loved on a Switch or on a PlayStation or an Xbox, plus Nintendo games. That right there is a extraordinarily powerful differentiator relative to the other two. Now, this is, there's more to it. I mean, for example, with a Switch, not only can you sit and play in your living room, but you can grab it, take it on the go. So in terms of like use case functionality, not only does it have an edge in terms of content, but it also is far more flexible than, traditional home-based consoles. So right there, competitively speaking looking out the next 10 years, I would not want to be in Sony or Microsoft's position for a few reasons. And there's incredible inertia in, call it the Xbox and PlayStation ecosystem. I mean, this would play out over a long period of time because most people play because that's where their friends play.
But dude, what was wild, and I agree with where you're probably going with this, but what was wild is living in Chicago when the Switch came out, you could see it around you.
Oh, yeah.
It was like people were on the L playing it nonstop, and I was like, oh shit, that's kind of wild, right? Because this is a form factor that has changed people's habits.
Exactly. And it's something that could never have been done before. And this gets kicked into overdrive with the Switch 2, because at the end of the day, a lot of people, for example, are worried about, maybe they can play games that they can come out with all these, Madden, FIFA, Call of Duty, but, are they really going to be as good as, or look as good and play as good as the current, the PS5 and the Xbox Series X? And for Nintendo to be a home run, it doesn't necessarily need that to be the case. It just needs to be powerful to play or to port those games in a way that doesn't ruin their gameplay. Like, so you're playing Call of Duty, the internet lags, and you're shooting at people that aren't there. They're shooting at you. That could be a big barrier. And, I think what's so interesting about a lot of kind of the news and specifically the delay that I was talking about earlier with the first party side, the negative compounding from the delay in the Switch 2 causing a delay in the amount of games they can release every year has to do with taking the node or, basically Nintendo had the GPU that will be powering the Switch 2 is call it, 5 to 8 times more powerful than the original.
Yeah, I remember you wrote about this.
Yes. So that's interesting in and of itself. But I think Nintendo delayed, a big part of the delay in the launch of the Switch was because they decided to move to a lower node, a 4 nanometer or 5 nanometer node that will actually save them money. I mean, this is a very interesting, conversation on its own. But the point is that, from Gamescom and Tokyo Games Fest, so Nintendo has been doing side demos with various developers behind closed doors over the last, call it 6 months. And, kind of the universal, I don't want to say leaks, but, the commentary from the developers that have seen it, basically their mind was blown in that, they not only match the current systems and load times and all of that kind of thing that's becoming increasingly important in the high-end gaming world, but they did a demo of the Matrix remasters, which was the same one that the PS5 and the Xbox used to highlight just how powerful their new hardware was. And kind of the universal consensus was, oh my God, these games look, feel, and run as good, if not better, than current gen systems. And, how could that be possible? And the answer is their partnership with NVIDIA. So I think on a base power level, the handheld Switch 2 will be as powerful natively as the Xbox Series S, which is the all-digital version of their next-gen system and is, kind of incrementally less powerful than the X. But the secret sauce here is the addition through their partnership with NVIDIA to use their DLSS technology and ray tracing technology.
What does this mean? Explain this to a 5-year-old,
Yes.
please. Me being the 5-year-old.
So basically, what DLS and ray tracing does is it uses AI to upscale games that maybe run at, we'll call it 780, basically run.
Oh, no shit. So you can compress it a little bit more and then the chip will, your user experience is much better.
Yes, not only that, not only does, so that's how they look and feel like current gen games. But not only that, and this is something that I think people also miss, you add that AI to hardware agnostic forms of AI that have already been built into the graphic libraries of the, Switch 1 libraries. But if you buy a Switch 2, not only will you have access to all of these incredible, third-party AAA games that have not been released, historically, but the actual games that you bought on your, original Tegra-based device will run and look vastly better because of the DLS and ray tracing technology.
Even on your TV, they will?
Yeah.
Huh. And I can take it with me and it still looks dope.
Yeah, correct. Exactly.
That is interesting.
Very much. And, so let's think about what that's worth, right? So, there's a couple ways you can kind of broadly triangulate this thing, but high level. So, one way, super simplistically, you could think about it is of the active user base on the Switch platform. Let's just simplistically assume 20% of that user base buys one, single 3P AAA title a year. Call it 25 million units. Most of these games have had price increases in the interim to 70, but let's use 60 per game. That's roughly 1.4 billion in gross revenue. Times that by the 30% eShop tax, that equals roughly 430 million in pure margin recurring revenue. Less taxes, it's roughly 300 million. Call it a 20 times multiple on that, you're looking at roughly 6 billion in incremental value creation. I think the better way to think about it, though, is I'm going off memory here, so feel free to double check this, but I believe PlayStation and Xbox sell roughly 200 million third-party units per year that never come to Switch. So if Nintendo can get, say, just to be conservative, 25% of that, that's 50 million at the higher price point of 70 times the 30% eShop take rate, you're looking at about roughly 1 billion. in cash flow, incremental cash flow from 3P AAA titles coming to the Switch 2. Tax affect that, and that implies roughly 15 billion in implied equity value creation. And again, this is incremental. So today's EV is 35 billion. We just talked about what happens when first P software, the release pipeline normalizes, and how that basically adds an incremental value of 30 billion to Nintendo's equity from that. If you presume that normalization through the cycle. And then, the addition of, I think, what are kind of obviously very conservative estimates in terms of the uplift from third-party games that weren't on the Switch before that now will be, that's another 20 billion. So when you talk about the future versus the past, I mean, we haven't even got into the Nintendo Switch Online, and all of the other, the IP entertainment earnings engines like movies.
Hang on. All right. I got you. This is very interesting. And thank you for doing this with me. All right. So I see why you want to own such a large stake today, given your perceptions.
Yes.
How do you think about this? Let's say Nintendo doubles, just from like what you've learned over time. How do you think about portfolio management in that case? Right. I mean, are you looking at this like this is a business I want to own forever and I think they have a bunch of optionality? Or is this a business that, I mean, I guess what I'm really getting at is this like a never sell type business for you? Or do you start trimming it to move into other parts of the portfolio?
So this is a really good question, because I think the hardest part of what we do is, when do you sell? And especially when you start with such an outsized position to begin with.
Yeah.
I think the answer is, could this be a business that could continue to compound for the next 10 years? Easily. Will I continue to hold it as long as it's, call it nonsensically, as disgustingly mispriced as it currently is? It'll be hard. It'll depend where it trades. But at the end of the day, I think if you zero out almost all of the, what I would call the high probability options that, are, by high probability, I mean, the odds of them landing deep in the money, if you will, 2-3 years from now, it's hard for me to see any scenario looking out 3 to 4 years where the equity doesn't go up. When I think about tactically upsizing or decreasing the position, given what, theoretically would make it become a very outsized piece of the portfolio as a whole, that is kind of a little bit harder. For example,
I mean, at that point, if this all materializes, you're doing pretty well for yourself and your LPs are pretty happy. So like,
yes.
So I struggle with this, right? Because like there's the theoretical, well, you should always optimize the portfolio all the time. There's the other part of me that's like, well, if you're doing really well and you like the business you own and it's got options, like, I don't know that, sometimes optimization can be the enemy of good. And sometimes good is good enough.
Well, it's like a classic story. You got to think about opportunity cost here, right? And, one, familiar story that, always makes me chuckle with my grandfather is, so, and I think it was 1999, he decided to buy a lake house for the family in a place called Okoboji. It's on the Iowa-Minnesota border. And he just agonized forever about whether he should sell Berkshire stock to buy some boats and jet skis. And, you can't take it with you. The money's useful only insofar as you can.
Yeah, I feel like Munger would say, sell some damn stock and enjoy your life.
Correctly. That being said, my grandfather was hard to get flustered in a variety of ways.
It was probably like a couple $1 million jet ski.
Oh, you have no idea. So the few times I saw my grandfather get pissed was because his buddies would bust his nuts.
I'd give him shit like crazy if I was his friend.
They kept a rolling mark of how much the boat and the dock and all that stuff cost him.
Oh, those are good friends. You need people like that in your life. And you know what? That's a good problem to have. I'll tell you that.
Yeah.
That's not so bad.
Extraordinarily lucky in a million different ways. So, and he never regretted doing it, but you wanted to agitate him, just remind him of the opportunity cost of that sale. So
I've been dealing with it a little bit with this house, man. And like, look, it's very nice. Okay. But I've been going back and forth. I'm not 100% convinced I'm going to be able to afford it for my entire life. And I guess what I've gotten to is like, if I can give my kids a home that they're happy living in, and it's something that when they grow up, they're like, man, remember the house, that we lived in and that was so happy. Then like, what the fuck do I have money for if I'm not going to enjoy it on that?
Dude, you're exactly right.
And like, who's the I will teach you to be rich guy?
Napoleon Hill?
No. That's Think and Grow Rich. But this is Ramit Sethi is this guy's name. And his whole theory of spending is like, spend where you want and cut mercilessly on everything else. And I kind of wrote down like, okay, the two things that I want to spend on are like health and family. To me, it's like I'm not giving up my trainer for now, and I'm going to spend on my kids. And if I got to sacrifice other places, so be it.
Dude, I think that's the 100% right way to go.
And I hope they don't look at me and they're like, you fucker, you could have stayed invested and we would have had more money when you died. I hope I raise kids that don't say that.
Yeah, right. You and me both. And you'd ask me, is for as like thrifty and just the way that generation of, call it, men in Omaha grew up. I mean, my grandfather very much cared about, saving and all those things, but he also was also incredibly wise. I mean, again, you can't take it with you. And, I look back now as a kid growing up. I mean, so my dad comes from a family of 10. I have like 62 first cousins. My wife's family is equally as absurdly large. And I got to tell you right now, the lifetime of memories that we built, I'm also lucky that I actually love my cousins. I think that is, very unique. But I mean, the amount of fun and memories, I mean, it's not even a question, at the end of the day. And I have no doubt that my grandfather would feel the same way. I think he'd be the first to tell you that it's not even close, that he would take the memories and the fun and the joy a million times over.
Yeah, I tell you what, man, it feels kind of trivial even talking about this stuff, given what's going on in the world. But, I don't know.
True. Let's just put it this way, where we both have everything in the in the world to be extraordinarily grateful, and especially in the context of what's going on in the world. It's
dude, it's wild.
I mean, you know what I would give, speaking of talking about kind of the baptism of fire with the financial crisis, just the ability to focus on investing bottom up with no consideration to I don't even know what that's like. Like my entire career in some way has been the incremental stress of, the fact that we did not deal with the issue the way we should have coming out of the financial crisis, zeroed out the equity, given the bondholders equity in the banks. I mean, there's a variety of ways, we could have, taken the pain and moved forward, under a much more, call it anti-fragile, world going forward. And the opposite has happened with the QE, and the unwinding of QE. It's like, I can't remember a period where in many ways the macro didn't terrify me. And, it still does today, maybe more so than ever. And, what it would be like to be one of those, to be able to invest as a value investor and not have to worry about, cascading financial collapse, given the interconnected nature of the financial system. I could go on and on and on, but
do you think Buffett and Munger truly don't I think they're very macro aware.
Oh, and I am too. I'm not saying that they're not, or that they always, that they've never been.
Yeah.
But from like a structural perspective, I think it is far more, I think it's completely unreasonable today, given the unique, dynamics associated with the world we live in now, not to pay attention. I think, in pretty much every other era, it was intellectually defensible to pay little to no attention, or, I just think quality, it's a different world now than it was back then.
I don't know, man. World War II, the Great Depression. I got to think it's always been tough.
Well, touche. It has. Scary things have always been happening. I don't know. I still think at the margin, things like systemic collapse. I mean, it's like when we were talking the other day and I was talking about the first time I arrived in New York as we were getting the bar ready to open. I remember getting out of the cab and going to look for an ATM and thinking in my head, is cash going to come out of the ATM? And that's the type of thing I'm talking, about where granted, we've, at least in the US, we've worked through a lot of stuff, but, we've talked about before with Dan and Alex and everyone at Berkshire, it's like the situation we're in with the regional banks. I'm not at all convinced. In fact, I'm quite certain, we haven't seen the end of, call it, a successive series, systematic collapse of a large portion of the regional banking system. I mean, I think it's a good thing we've been short. We've made a lot of money on this and we'll continue to hold our shorts until we can see some way through, a viable way through, which, I'm not sure I do. But that's, again, maybe my powers of articulation are failing me here. But I think at the margin, there's something fundamentally more scary about the macro environment and what external events can kind of do to what we do for a living that wasn't there in the past. And maybe I'm wrong on that, but I certainly feel it when I'm putting my own and my investors' money to work. And maybe this is also just a kind of a secondary effect of what I went through in the financial crisis that makes me feel it more than maybe someone else would. But I certainly feel it, and it's what makes me so, kind of maniacally focused on the downside. In the end, the upside will take care of itself, but it's getting harder and harder to find names that not only are very high quality, but whether it's via idiosyncratic levers that they can pull or whatnot, but that should result in predictable growth in revenue and cash flow, whatever the future holds. And I think that is, at least for me personally at Crossroads, that is something that is essential to what we do. I mean, almost everything in our portfolio should work regardless of what the market and the economy do. And it's a high bar. I'm lucky because we can be concentrated. I only have to find one or two great ideas a year. But I think it's just a lot harder to find things that should work no matter what than it used to be.
Well, this is not a unique thought. I'm stealing it, but it's one that makes a lot of sense to me. And I would name the person if they gave me permission. But they said, if you look at the asset classes that have done well over the past, I don't know, call it 20 years, the one that really hasn't is like the long short hedge fund. And I kind of wonder if this isn't the decade of people being like, oh, we were under allocated to hedge funds, like real hedge funds, not like just as a payment structure.
Right. Right. Well, we could have another, call it, like the value renaissance coming out of the, tech bubble from 99. I wouldn't be surprised at all. I think dispersion is kind of there. I mean, now's a strange time in that, it's like when people talk about, or frame value investing in like a French way. I believe you guys were talking about this the other day on the pod you did with Toby, basically talking about the value spread. I'm not at all convinced that, we're going to see a reversion to the mean based on, call it, small cap value. I mean, small cap value is my bread and butter. Don't get me wrong. And I think there is some of, if not the most extraordinary bargains available in the small cap world today that I've seen in my career. But this idea that we should see a cyclical reversion in, value versus, call it, large cap growth, for a bunch of reasons, I don't buy it. I saw a super interesting chart the other day that showed that, basically the 100% of the increase in gross profit from 2007 onward, has been driven from tech. But I think there's outside of the way, business models and the quality of businesses have changed over the last, call it, 40 years. I don't even think small cap value is even outperforming more if you start from, call it 1980. But, GAAP metrics like book value are becoming increasingly less relevant. And you've had a qualitative kind of step change in the nature of American business in general. And almost all of that has been driven by tech. And, you have this just incredible adverse selection in the small cap indices. I mean, you got a ton of barely, viable regional banks, just a lot of low quality businesses, that are affected by interest rates. Most of the indices are filled with crap, for lack of a better term. And so, presuming that the reversion between, say, small cap, value and mega cap growth is going to automatically revert, like this is some iron law of the universe, I think is deeply misguided. And I think when you kind of peel underneath the hood and you see the drivers of, for example, like I said, all of the incremental gross profit in, U.S. corporate income or cash flows has been driven by tech. And, what we've seen there, that's a structural change that's permanent. Let's just put it this way. I'd probably much rather buy the Magnificent Seven here today than buy, the Russell 2K value.
Gonna break some people's hearts. How dare you come on this podcast October 17th and say this?
I mean, hey, I think, you pick your spots. There's bargains of a lifetime out there in small cap value. But dude, investing isn't meant to be this easy.
Dude, I don't know that people think it's that easy. I mean, even since it got cheap, it's been hard to. I mean, the small cap has gotten punched and punched and punched, and I don't think it's capitulation yet. But it has not been fun. Yeah,
well, I agree with that, and there's obviously, it's kind of like rubber band dynamic. There are limits to how far I think the spread can go before an inevitable snapback. But do I think it will revert all the way towards the mean? No. And I think it shouldn't because of the structural reality of the way the businesses that compose these indices, have changed. And, I could totally be wrong about this. Don't take anything I say on macro. You take it as a grain of salt. But when I look at the businesses, you back out the unprofitable ones. I mean, they're cheap, but I don't think they're so cheap they are unsustainable. The valuation is fundamentally unsustainable. I think is kind of the premise underneath a lot of people's hopes with respect to mean reversion. So it's not that there are not incredible mispricings in the small pays. I mean, I think the changes in market structure since, the financial crisis are both incredible and real in the sense that, you add all the monetary policy and, all of the, QE angles to things, and you combine that with the rise of passive, you have a scenario where I think the market's discounting mechanism in the smaller and less liquid fare, of the market has been completely broken. And, if you want to know one of the things that I think I recognized early, in part from, having my head chopped off in a few scenarios was, I think early in Crossroads and, after launching the fund, basically from day one, I was pretty aware that the discounting mechanism in the smaller micro and small caps, less liquidity, all that was very, very real. And one of the things that had, I think tactically that has made a huge difference and saved me from a lot of the pain that other managers have gone through was that I realized it was broken when I started the fund. And the only way that I could kind of sidestep it without abandoning, what I think is and always will be the most structurally inefficient pocket of the capital markets, at least relative, if you're talking about size in a vacuum, I still absolutely believe that's the case. But, the idea that I would buy a well-run, smaller micro cap run by an owner operator that, owns 40, 50% of the float, has been buying back stock, does smart and creative things, not only to reinvest in the business, but, will return capital to shareholders. I would watch as businesses, for kind of years leading up to this they'd be cheap. Let's say they were trading at, as a above average business that, ordinarily should trade at an above average multiple, call it 20, 25 times, trading at 13 or 14 times. And I would watch them execute and, continue to do what they do. And I'd watch the multiple just compress and compress and compress and compress.
Yeah.
And so the tactical change or the way I kind of adapted and evolved was, I kind of put in a hard, bright line rule. Like, I will not invest in a small or micro cap name until I have a clear, hard, very distinct idea of what's going to work, make it work, and when. And, I know we're both fans of Druckenmiller, but, one of the things that
You probably more than I.
yeah. Well, so one of the things that really kind of opened my eyes to this was Druckenmiller's emphasis on liquidity, driven catalysts.
Dude, did you see Lululemon on that index inclusion?
No.
It was up 10%.
Well, there you go. So
it's Lululemon. Like, come on.
Hey, I mean, but this is...
You gotta be fucking kidding me on index inclusion.
But this is what I'm getting
at. But
at.
Who's the dummy? Me, the guy that complains, or me, the guy that like, I should be the guy that's like, okay, well, now I'm just going to play that game.
Well, that's kind of what I've done. I overlaid, I need a hard catalyst that is going to result in this smaller business getting kind of swept up in the liquidity-driven flywheel that, has come with, the rise of passive.
Yeah.
I mean, it's a capital flow thing, right? And the cheap, something, it's like the old comment from, Graham about, or it was, I can't remember if it was Graham or Buffett that originally was responsible, but, talking about how the market is in the short term a voting machine and, weighing machine over the long term.
Yeah, long term a weighing machine. Yeah.
Well, this kind of period made me question, well, like, what happens if no one shows up at the polls?
Huh. Oh, I like how you said that.
Like if there's no capital, on a structural basis that, even exists to drive price discovery, that's kind of this invisible hand dynamic that things are going to naturally revert to the mean, and that value creation will immediately be awarded or rewarded in my bread and butter space, kind of goes out the window. And so the way I kind of switched things up was by buying things where I knew, over a predefined time period, quite literally what was going to make it work and when. And catalysts that, by hard catalysts, what I'm really talking about is this liquidity dynamic. And so, one could be, a business that is a pure play, very high quality, very coveted, a massive amount of embedded kind of natural investor demand, but where there's been barriers blocking that demand from kind of flooding into the equity. So, a simple example would be an uplist to a major exchange. And in this case, the business I'm thinking about was, traded in London, Knife Island, as Dan or Alex would call it. But it was in the process of uplisting to the NASDAQ. And so in this case, there was, a clear situation where you had kind of finite amount of sellers, there, and a barrier to investment that was, basically holding back this avalanche of investment demand that would like to invest, but couldn't because of mandate restrictions related to the exchange they trade on, what have you. And so as that, basically you skate to where the puck will be, you have a clear, idea of what is going to make it work and when, that uplist happens, the barrier to investment drops, and all of a sudden you have this massive amount of incremental demand for the equity that couldn't get through before, that is trying to squeeze itself into call it a limited float stock with a paucity of sellers. And, very good things happen to the pricing action when that happens. And then that will generally lead to, as they get a bigger market cap, that'll lead to index inclusion, and on the flywheel spins. Above all, me kind of waking up to the reality of market structure kind of being broken, or at least the discounting mechanism in the space that I love the most, and kind of pivoting towards only names that fit all of our qualitative and quantitative criteria, but that also have a hard liquidity-driven catalyst, has made all the difference. And, I don't think this is any blinding insight that I had, but maybe it's better lucky than good type thing, but it has made all the difference in the world and saved me so much pain and stress, of dealing with situations where they execute according to plan, but they just kept getting cheaper. There's no kind of embedded demand for the equity, and the structural factors driving that are getting worse. It's not an easy game, but kind of putting that rule in place made a huge difference in, I think the outcome that the fund has experienced. And, frankly, I don't see any time in, the near future where that's going to reverse. I hope it does. I hope, kind of the sea change, I think that we've gone through recently with higher rates and, all of that might fix those type of things. But I think we're dealing with a fundamentally different beast because of its structural nature than what we were dealing with kind of pre-financial crisis.
Well, that's kind of why I said to Toby, I was like, I don't know that I actually think that small and cheap is going to win. There are a few companies that are like small and expensive that, I mean, they tend to be in healthcare, and I don't really know what I'm talking about here. But, I think that there's a chance that, like, okay, the takeout value is higher, but there's a reason that they're public and they're not. I think that they've gotten compressed with the flows out of small. I forget what Chuck Royce, I think I heard, I have not verified this for myself. I think Chuck Royce's assets peaked in excess of 30 billion and are down to 6 now. So if you just think about, like, if he is the prototypical small cap investor.
Yeah, that's driving price discovery. I mean,
yeah, like, dude, what's gone on? Like, the entire time when he's been redeemed on, like, everyone else has been too, right? So it's just selling. Well,
so here's this is an interesting question, and it's actually one I've thought a ton about. But, the truth is, I mean, when I graduate, going back to the very beginning of my career, when I think, let's say 2004, 2005, not only were kind of value investors and small cap value investors king, in a variety of ways, but, the number of small cap value, small cap in general, mutual funds, hedge funds, when I think about, I mean, basically everyone's gone. Like if active managers in the small and micro cap space need to exist to set or drive price discovery, especially, indexation, in fact, is, fundamentally requires this premise for it to actually work. What happens when there are no more small and micro cap, like institutionally speaking, they've been erased off the face of the earth. I mean, even now raising money, it's like with the long short hedge fund, example, raising money despite spectacular performance is an absolute nightmare. People in the alternative.
Why is that?
I think in part because, the pod shops have created a good product. I mean, I think when you think about the leverage and, I could talk shit about them all day, but, the point is, I think on some level, they've created a better product. I think the dramatic underperformance of equity long short hedge funds is, a factor in this. I think the vast majority of hedge funds that were created that have, either since gone out of business, but that are doing the long short thing really had no business doing them in the first place. So I think you've got a lot of kind of, call it pretenders that shouldn't be running funds because they can't add value, whether it's over a benchmark or whatnot. I think that's created a terribly sour taste in people's mouth because, the returns have been terrible and they haven't delivered. And so I just think it's a couple of things. But when I think about where is the capital that's going to flow into the small and micro cap space going to come from? You mentioned Chuck, who I adore, and, that they peaked at 30 billion. I mean, they're really the last man standing. I don't know of any other material kind of mutual fund household name that even plays in, the pond where I continue to fish in and, a lot of our, close friends and associates do. And so that's part of why the, layering in a hard catalyst that'll drive, a predictable outcome in terms of the end game. But it's also in part because, the amount of capital that is driving price discovery in the space has basically disappeared. And I don't see any equivalent replacement anywhere near on the horizon. I mean, I'm not saying it doesn't happen, but all I know is that I'd say 80% of, a lot of the funds that I used to admire or look at in the space, certainly coming out of college, are either gone, or, a tiny fraction of the size they were. And I think that's a huge opportunity for, a fund like Crossroads, but because the mispricings can get so extreme, but I don't see.
Yeah, dude, unless you are on the other end of just like getting hit in the face with multiple compression and your LPs are like, what's going on? And you got to write these letters about how everything's going according to plan, but everything is flying in your face. And then it's a terrible way to live.
Yes, no, you nailed it.
And as long as everybody believes this, it's going to remain true. Now, I guess if I wanted to argue the other side of it is, boy, if that belief flips, look at how much money can come into it.
It's like attitude in Japan.
Yeah. I mean, you're not wrong, but it's the old thing. Like, do you need to catch the first inning of something, right? You can maybe play in the third inning and still get a good part of the run.
Oh, most of the time, I'd much rather, if I'm looking at the risks in an investment and I have two choices, I can, wait through kind of the last material risk to, the thesis that I believe I've uncovered. And, waiting through that, event to come and pass, i.e., so I don't run into a buzzsaw, causes me to pay 20% more to have a vastly decreased risk profile from the downside. I'm happy to pay up 20%. I mean, I'll do it every day. I have no need to try and catch absolute bottoms. And, that kind of mentality or worse, making capital allocation decisions based on kind of abstract things like the value spread. They're not the type of bets that I want to make. I want, the unlocking of value to be forced by concrete events that, take the risk of what we're discussing out of the equation. Because if I can do that, I don't have to just chug my, Mylanta or, Pepto-Bismol. I mean, the heartburn, and this is the other part of it. Since I've kind of adapted my approach, I can't tell you how many sleepless nights I've avoided. It just makes it so much easier when you don't have to depend on or, kind of have a prayer session that this, historically extreme spread will somehow start to really compress. I mean, it's too abstract, too far away from kind of a direct line of sight to value, the price to value gap closing that I need. And I think if you're betting or making investment decisions based on a hope in basically what amounts to hope in this reversion taking place, and then, you get your investments getting kind of swept up in the slipstream of that reversion taking place, that's a hard place to be. I mean, if someone was asking my advice, I'd tell them to, rework their approach and do something a little bit more, simple. And, it's funny, it's especially talking to Dan and Alex about this, given, they were funded via Greenlight. I mean, this is essentially what Einhorn has come around to, too, in the last couple of years. It's, yeah, the market might be a weighing machine over the long term, but again, what happens if no one shows up at the polls? What happens if, you can't depend on incremental capital from, the usual suspects flowing in to correct these mispricings? You really need companies that are willing to do it themselves, or better yet, if they become a capital return vehicle where, they're continuously shrinking their shares, the compressed multiple is actually a benefit. And a huge benefit.
Yeah, you gotta trust him at the end of the tontine.
Right. Yeah, exactly.
When I pushed back on the Druckenmiller thing, is I read like the description of the pod, and now that I know some of y'all better, I'm like, fuck, that's kind of embarrassing that I wrote it that way. But what somebody like Druckenmiller,
I knew exactly what you meant.
Well, and like what somebody like Druckenmiller has kind of like stretched my thinking on is just like looking at the world through this kind of a lens and being like, okay, it's I don't know, I went from this naive sort of like statistically cheap is going to work, which I think it still can. I think Toby's got a much more smart vehicle than I do if that's going to work. But like to kind of thinking about, okay, I get that it's better in theory if your stock goes down, all else equal. But like in reality, you do have to exit eventually. And exiting into no liquidity sucks.
Oh my God.
And like trees that fall in the forest are not fun to own.
No, they're agonizing. And trust me, like, I don't mean to make the impression that I haven't had my face ripped off more times than I can count. I mean,
No, I think you learn this by getting your
yes,
face ripped off.
hell yes, you do. I mean, it's the only thing that makes it stick. And, I'm sure we're very much the same. I mean, for a long, long time, I would have considered myself more of a Klarman-esque investor where, I would, like one thing I don't do anymore is generally speaking, you'd have to put a gun to my head and pull the trigger before I'd buy some commodity treadmill to hell business. And for years, I would get sucked in, I think before I finally took, say, oil and gas, mining extraction, things like that out of my playbook, I would, get caught in these, statistically cheap businesses that I would insist on a discount to asset value on top of earnings power. And I think that is kind of one of the things that differentiates, say, a Graham Klarman investor from, say, a Buffett, Munger Greenblatt investor. It's kind of crazy. It took me, I don't know, almost 10 years to learn this. But buying a business that has to reinvest every dollar it earns simply to stand still, where the incentives are wrong with management, you think you have this margin of safety and this NAV, whether it's, proved reserves, there's a lot of different kind of examples I could use here. And that we're trading statistically cheap relative to, their earnings, next year or the year after based on wherever the, say the price of oil or gas or gold was. And I would think that I was basically being doubly safe. And so you hear about Munger and, all their kind of quippy, pithy comments about how it's better to buy a business, a great business at a fair price. And it just stuns me. It took me nearly a decade for that kind of wisdom to really sink in. And it's in part because, growing earnings, all of the things that drive value. I mean, in the end, the most important thing, I think, with respect to a long-term outcome in any business is not only the size of the moat, but the duration of the moat and, how predictable their ability to continue to earn outsized returns on capital are. While in theory, the margin of safety from the discount to NAV and the low multiple, like the qualitative element was completely missed. And the older I get, the better I get. I realize that 99.9% of alpha is qualitative insight, in particular, qualitative insight that isn't properly appreciated by the market. And that has made not only, our margin of outperformance and, our returns vastly better, but it's made the stress, the day-to-day weight of, this job naturally incredibly less crushing because, time is on my side. And with a lot of these statistically cheap business, it's the opposite. And, in the end, I just don't think it's worth it. I don't have to buy everything. I just need to know the limits of my own knowledge. And at the end of the day, setting an extraordinarily high bar qualitatively for what we're willing to invest in, it has saved me in so many ways from making poor decisions that, are tempting. I mean, I still get tempted to dip into cigar butts here, now and then. And, I actually owned a few things that I think that trade like a cigar butt, but I think qualitatively they're dramatically these businesses are grossly underappreciated. But, the point is that ultimately quality and insistence and a high bar on quality and sticking with kind of maniacal discipline to that high bar, especially if you're concentrated, has not only, resulted in far better returns, it's allowed me to sleep like a baby at night in a way that was just, first 10 years of my career, it was a very different thing. I mean, I still did well, but was the return on invested brain damage and the collateral, heartburn from owning lower quality businesses, worth it? Oh, hell no. I mean, like, it's the best decision I ever made was doing that. And it took me a long, embarrassingly long time to figure it out. But there hasn't been a 3 to 5 year kind of period interval since where not only have the returns gone up, but I'm just a lot happier and more at peace. And I think I can make, my psychology is always where it is when things get scary. So I can run into the fire, for lack of a better term, without fear. And I think a big part of that is an emphasis on quality above all.
Yeah, I've been thinking a little bit about, the commodity space, just given the fiscal spending and some of the tightness there and of supply. And I keep coming back to like, dude, you have absolutely no insight that the market doesn't have. And the second it goes against you, you're going to puke. Second. So like, just don't do it.
Right.
Now, maybe it could make sense to give it to somebody else who I think has that insight, who can hold it. But like, I am not going to be capable of owning those equities. I just know it.
No, it's psychological torture. And so much, this is why, and I emphasized earlier about predictability being so core to, kind of the way I look at the way we invest is I want to find the highest quality business I can that is, as absolutely dirt cheap as it can be looking out 2 to 3 years. How cheap is it relative to its medium term earnings power? And that was another piece of the puzzle that I think both Greenblatt and Druckenmiller really crystallized for me. It's I need to be able to predict what a business should earn at minimum 2 to 3 years into the future with the very high degree of predictability, or I'm not going to touch it. And that automatically
that was my biggest mistake last year. Was buying a business that when I looked at myself in the mirror this year after living with it for a little bit, and I was like, you really sure you think this thing's going to be bigger in 5 years than it is today? And I was like, no. And that was a sad moment in the life of Brewster.
Well,
but whatever. You live, you learn.
Hey, I've had many of those. Honestly, though, that's the other beautiful thing about this business, though. It's, knowledge is cumulative. It's one of the few areas in life where age and having enough scars on your back, almost guarantees you get wiser with time. And, it's like, I'll continue to make, the worst thing is, I think I put this in our last letter. The only thing bad about it was a little bit different this than, learning or not learning from your mistakes is basically the key, I think, is to actually learn from your mistakes and not repeat them again and again. But, that is kind of, there's going to be some element of that is always going to happen. And it continues to do. And, I focus a lot of time on really internalizing and learning from certain mistakes. But in the end, you're going to find yourself inevitably, I think, making the same mistake again and again. And, I take solace in the fact that I have a natural pain point before I'm just like, okay, 3 roundhouse kicks to the face is enough, and
yeah, I don't need a fourth.
I'm going to take this knowledge and learn from it. But it takes a lot of time and a lot of mistakes to get there. For example, the way I played, I think, so at Crossroads, maybe this is me getting cute in it, but, the way I've dealt with, for example, I do think exposure to energy, given the macro, something levered to, call it the energy ecosystem is smart. But the only way I could think of to play it or that I could get leverage to that kind of outcome is, I bought a bunch of ET, which I kind of think of as the Standard Oil of energy infrastructure in the United States. I was basically bought it at it was right around 10, but the implied dividend yield that should, have continued to grow and over time will grow was, I think, 15%. And given the predictability and the stability with that business, I think I was able to, I guess from a portfolio management, portfolio structuring perspective, get something on that would do well no matter what, but especially if energy prices skyrocket. And there's a lot of different scenarios where I can see that happening. And so, ET was kind of a way for me to kind of not make a similar mistake as I've had in the past, kind of do it my way where the predictability element is there in a manner that, I think fits all of our quantitative and qualitative, bars, for an investment in the fund. But, I still think ET, I don't know what its dividend yield is now. I think it's slightly under 10. I'd rather own, if we're playing what's the risk-free rate as, kind of a barometer of your opportunity cost. Risk-free rates are 5%. if I can make double the risk-free rate, in dividends every year, and the earnings power of the business, is not only predictable, but should continue to grow over time, that's something that I think should do well, regardless of whether rates stay high, whether they drop back to the floor, kind of under all scenarios. I think that was a way to kind of split the difference. But I should say every time I've tried to split the difference in the past, it has not worked out as well as I had hoped at the time. But I do think ET's worked out fine. And as far as the medium-term future, I think there's a lot of visibility and a lot of reason to remain quite bullish.
That makes sense to me. I think, with some of those ideas, for me, I just need to really own them and not, if I owned ET, I just need to be look, I own these assets. These assets are great. They're giving me cash back. That was the plan. Let the plan do its thing.
Yeah. Yeah. I mean, it's hard, but this is the benefit of, people joke and they laugh about, the books I've written on Nintendo. But that's kind of the thing with when you have a 25% position or you are super concentrated is I basically, the amount I know Nintendo, it's incredible how deep, I could not feel more comfortable with this business because I've been able to allocate an arguably unhealthy amount of time to not only immersing myself in all the details, but, I've owned it for 5 years, so that I think is really the key. It's getting into the details of a business, knowing it as an owner would, and, especially with something like Nintendo where, the famed Nintendo speak tends to shake people out like crazy because they're either confused or they read things the wrong way. It's actually quite incredible. But if you've studied, Nintendo speak as long as I have, and you understand the culture and their past behavioral patterns and, all of that kind of thing, it makes it infinitely easier to distinguish between, when, say, the stock's selling off for nonsense versus, a reason that actually is, fundamentally or technically valid. And I do think that investing at least as if you are an owner and you wouldn't, potentially own it forever has been a big, it's a big part of our success, certainly, because like you said, you think something's interesting, you don't know it very well, or you know it well, but you're not obsessive about knowing it. Then the macro turns, maybe the cycle turns, something like that. You don't really realize how much you don't know until you've already gotten your ass kicked. And that's a hard position to be in where, if you're concentrated in things you do know extraordinarily well, and you have a very clear line of sight in your head in terms of bridging what they're earning today versus what they will earn 2-3 years from now with a very high degree of conviction, that's the type of thing that makes all the difference. At least it has for me, which is why whenever my portfolio starts to get bigger than, say, 12 to 15 names on the long side, I almost immediately trim it back because, I don't know what, this idea that someone could own 40 or 50 stocks and know them well enough not to get pretzeled on the regular, I just don't think that's possible.
Yeah. Well, especially not the way that you know your stuff. Which, speaking of which, because we got about, 20, 25 more minutes, can we do Pubmatic?
Sure. Or adtech?
Yeah. Yes. My apologies. I just, when I read the Google paper, and that's what I'll refer to it as, I discussed it with you and you were like, this should not be construed as a Google short thesis. That is not what was going on.
Totally.
So I want to give you the opportunity to clarify for anyone that's like me that may have sort of misunderstood the paper generally.
So I should give full credit to my new director of research, Daniel Prather. It's actually funny. We've been very close for 5 years, and I only learned I was mispronouncing his last name a month ago, which is absurdly ridiculous. Nonetheless, it's true. So, Daniel and I had worked together on various names for, any number of years. And for a lot of reasons, I think there's a big symbiotic relationship there in terms of, kind of my sweet spot and his. And, we've always worked together very well. And so when I was able to bring him on, about almost a year ago. It was a really wonderful thing to kind of make it official. But long story short is, Daniel has a long history of kind of distinguished write-ups, particularly in the tech space. He was a former rocket scientist in a former life. And, when it comes to the technical stuff, he's always kind of blown my mind and, certainly been someone that, when he pounds the table for me to look into an idea, I normally do. But as we all kind of know, sometimes, you're so absorbed or kind of involved in a name or, a different part of the portfolio that someone could serve you up Berkshire Hathaway in 1965 and you'd be like, meh, and kind of move on. Well, in the case with adtech and, Magnite in particular, Daniel was very kind of kind and patient with me, but, he kept being like, Ryan, you need to take a look at Magnite, particularly the antitrust case around Google. And, he had owned what is now Magnite. I think he first pitched me the name when it was Ruby and it traded at a discount to cash. So he had owned the name for a long, long time, kind of knows ad tech like the back of his hand. And more importantly, because he had stayed up to date with all the incremental developments in terms of the antitrust case, was kind of acutely aware of how that case has evolved over time and, the implications of that case. So I'll start out with Daniel basically saying, hey, Ryan, take a look at, the merits of the Google ad tech trial anti-case. And I should probably begin here by noting there are two cases the DOJ currently has against Google. The first is in search, and that's ongoing right now. But that is, we don't really have an opinion on that case. I think it could go either way. But, Daniel basically got me to stop everything I was doing and, really kind of focus everything I had on getting up to date with the antitrust issues as it relates to Google and Magnet as a standalone investment. And so for a variety of reasons, I would not look at, we are somewhat agnostic on Google as I definitely wouldn't, there's a reason we didn't short it. And it's not a short piece on Google. What it is a piece that describes what happens if Google loses the second DOJ case and some details surrounding that. So I think what did it for me to actually really kind of stop everything I was doing and jump in was he had, there's 3 or 4 very intelligent, very thoughtful investors that we both know well. And because I was being difficult in terms of my attention, Daniel decided to basically write up a kind of a thesis on the antitrust aspect of it and do it in the old Benjamin Graham way, which is kind of like a riddle where, company A, company B, company C. And he had sent it to all of those 3, the people that we both do in common that were long Google and very smart and very thoughtful. Well, when they came back and all of them, one of them ghosted us and, we presume was because they were liquidating their position and then got back to us 2 days later. But
I gotta go.
Yeah, right. But every single one of them was like, holy shit. Thank you for that. We had never put any real time into it. And so that got me into kind of the general thing, which is, every Google long we talk to, and, I think Bill Ackman's, recent discussions, his long thesis and the latest Pershing thing, I think it's kind of amusing that there is literally, the reason it's mispriced, he says nothing about either antitrust case being an issue at all. And I think that is generally, kind of the universal reaction when we brought it up with people has been, well, what do you think about the antitrust case? And they'd look at us like, dude, well, it's like, who cares about that? It's irrelevant. Or, the reaction would be in a few cases, well, yeah, I'm aware of them, and I actually hope it happens because when you break up the sum of the parts, they use the classic Standard Oil example where, Rockefeller's net worth, I think, tripled or quadrupled after, his trust was busted because the market was forced to assign and place a value on all the, individual pieces that, that unlocked an extraordinarily amount of value. So basically those were one or one of the two answers that we got kind of universally, and this is from super smart and thoughtful people. Well, as I dug into the details of, not the search case, but in particular the adtech case, and I was utterly shocked by what I found. In fact, all of Daniel's insistence and continuing, and thank God he kept with it. So I started to dive into all the court documents, and a good buddy of mine, Tuan Tran from 10 West, Y Combinator on VIC. I think a lot of people will know him from there. Created a kind of an AI side hustle that he built internally himself and hired a guy to run it. But the two of us worked together to basically feed, what I call AI C3PO in terms of the antitrust with, all of the DOJ's, court documents, RPs, all of Google's answers. And, that was incredible because it really the first time, in terms of use cases where I'm not sure I would have been able to ramp the learning curve. It would have taken me 10 times as long as it did. It was really amazing. In fact, I can, when this goes live, I'm more than happy to post an example of it underneath the pod so people can play around with it. But that was what allowed me to really dig into the details of the case. And long story short, past precedent in terms of antitrust law, there's nothing wrong with being a giant corporation. There's nothing wrong with being a monopoly. Where antitrust law comes into place is when, a monopoly and is using their market power via various anti-competitive measures to extract economic rent or profit unfairly, where they're basically just sliding the torch to their competition. And so it is when you dig into that aspect of, the Google antitrust trial and that, the power of the DOJ's case really comes to life. And I can remember being very confused by the Microsoft Activision deal and a lot of where the government was coming from at the time, because it just seemed so silly and absurd on several levels. But, going through this part, all of a sudden, all of that made a lot of sense. Now, I think the, DOJ was, or the antitrust issue there was silly. And I didn't change my mind on, like the odds of the outcome. But those two things kind of really crystallized to me what the case that's going to win. And, historically, the DOJ doesn't take cases unless they're basically absolutely certain they can win. And our buddy Andrew Walker just came out with I think a fascinating piece on a sea change in antitrust laws that I would recommend everyone read. But I think Google is the opposite of that kind of general sea change, which is, I think the odds that the DOJ will win against Google are not just possible, I think it's actually probable. And, I would point you to the piece to kind of go through and get a feel for the arguments to why, and potentially use AI's, antitrust C3PO to maybe ramp the learning curve on our conviction there. But the point is, it wasn't a short on Google. It is actually a long on the beneficiaries of who will basically absorb all of the profit pool should Google lose, and should they have to basically separate their ad tech stack from their larger ecosystem, which in a lot of ways is equally as important or as powerful to Google's, moat and earnings as search is. And so one thing I would point, why I'd be cautious as a Google long is, you sever the network effect, that comes from their market position and, in advertising and their ed tech stack. And there's considerable, I'm not so sure that the pro forma earnings power isn't, at least temporarily, if not permanently impaired on that side of things. So, who knows about that? But here's the insight and the thing that matters. So without getting into the details, and trust me, ad tech is so complex, it can make your head explode. But, the gist of it is if Google loses, we're talking, all of the profit pool, there's a direct linear relationship where if they lose, there's going to be tens of billions of dollars, up for grabs. And that revenue, should it be ceded to the remaining players, Magnite above all, is worth, call it a 5x, kind of inflection in revenue. Basically, if this happens, for certain that, this group of companies is going to benefit. And so the question is kind of trying to quantify what that means to each of these companies' bottom lines should it happen. And so with Magnite, this isn't a short on Google. It is a fundamental bet bottom up on Magnite, irrespective of whether Google wins or loses. So, think of it as a 50-cent dollar. But should they lose, which again, I think is not just possible, but probable, if you buy the leaps, specifically, and it's even, the upside is even more kind of mind bending. But if, you buy the leaps looking out in 2025, you're looking at basically 100x upside. So, conceptually, I think of it like this. We get to buy the market leader in the ad tech space on, the sell side of the aisle at, what I think is a 50-cent dollar. And then we get basically a 100-bagger free option tossed in for free that I think is likely to materialize. Now, I'm sure a bunch of people are listening to this and they're thinking, well, how do you get comfortable on the timing, right? These things could go on forever. And in fact, at least with respect to the first DOJ trial that Google is going through, if they lose, there's going to be an appeal and, who God only knows when all of that will get wrapped up, in the end. Well, that's what makes the second trial so intriguing. And this is another key piece of it, is the second trial takes place in Virginia, which is called the Rocket Docket. And what is so important here is that, this particular jurisdiction is known for how fast it is to a conclusion. So historically speaking, cases in Virginia, the Rocket Docket, have, lasted between 3 and 6 months, but the average is about 3.5 months. There are no real exceptions to this. This is where you're at. You're going to get a hard final decision that, essentially can't be appealed by, let's call it late summer of next year. So that's the other key piece of this. It's not just the incredible accretion to the remaining players that will mop up all billions in profit, that is seeded by Google as part of losing, but it's the fact that we have a predefined timeline where we know the case will be wrapped up and done. And there is plenty of room between the time that case gets, basically settled and the time the options expire for the kind of absolutely transformational secondary effects or the implications of that ruling for the market to wake up and start to price, Magnite in particular, price that in, given the obvious and, very direct implications that are certain to happen should Google lose. So I don't know, that was kind of a long, ranty explanation.
No, it's good. It's good, man. I mean, when I read it, I was like, I don't see anybody else talking about this. And then I pinged you, and then I got the email back that was like, I'm the guy that you had dinner with. And I was super happy it was
fun.
you.
That was a fun night. Yeah, right.
And here we go.
But so that's what's unique. It's a small position for us. All credit is due to Daniel. He's been a Stone finalist and won VIC's idea. But in terms of the sheer creativity, because if you think about it, just by, like the odds that, the DOJ wins, or at least what's being discounted in the stock are, somewhere between 0 and 5%. I mean, basically, the market has not discounted any of this value creation whatsoever into Magnite stock. I think that is a huge mistake. I mean, I don't know what the true odds of, Google walking away with the W or an L are. I know they're not 0. And if you dive into the details of the case, I think most rational people, and we talked to a variety of antitrust experts, I mean, there was a lot of due diligence that went into this. And honestly, at the end of it all, there wasn't a single contrary view or, anything that touched the premises of the larger thesis here, which basically everyone agreed to. So the fact that he not only was familiar with, all of the details in the case, some of the stuff that was released was so embarrassing, the judge allowed them to reseal it. We go through that in the piece. But, and this is bad. I mean, puke-inducing grade A scumbag type of, actions on Google's part. Should they win, you're looking at basically a 100-bagger with the leaps. Most interestingly was, we did it not as a piece to say, hey, here we are, we're short Google. It was more about sowing that seed of doubt into existing longs. And because remember, the piece is about, hey guys, if you think the probability of a loss here is zero, you might want to, educate yourself, because that is almost certainly wrong. I don't know what will happen, but I know the odds priced into a win here are wrong. But, simply by sowing that seed and getting people to realize that, hey, there's a really cheap way you can hedge your Google position against this type of negative outcome by taking say you got a 10% position, taking a 1% position in these leaps. It's just very clever, because it becomes a self-fulfilling prophecy. The more people wake up to this idea that, oh my God, I can toss and turn and worry about this all day, or I can just buy Magnite calls and sleep like a baby. That kind of, that's all they need to do. And if even a tiny, tiny fraction of the capital allocated to Google, makes, I think, the intelligent decision to hedge out this very easily hedgeable risk through a basket or of ad tech peers that are likely to benefit, or the way we've chosen to express it, which is, through an individual bet on Magnite, which is the biggest of all the beneficiaries, and that we believe should benefit disproportionately. If you do that, you're going to drive up the value of our calls. And so, we don't even need a loss, if you will, for the idea to work out. I mean, I think the idea from a bottom-up basis is going to work regardless of that outcome. But the way we've kind of set up the position and the way we've used kind of the truth to wake people up to the obvious, I think is extraordinarily clever. And it's early days. Won't be till the end of next summer where we know, the outcome here. But I guess the only way I think we lose is if Netflix steps in and buys Magnite for their own, CTV purposes. But that's a totally different thing. If they paid 100% premium, the leaps would expire worthless. But I do think there's enough time to where heads we win, tails we don't lose. And it's, not every day you get a free 100-bagger option tossed in for free, especially when that option is, I think, more likely than not to land in the money.
Yeah. No, I like the way you were thinking about it, and I wanted to make sure to ask about it, because I would be lying if I said that I fully let my brain get there, because when I read your paper, I was like, oh, this is something that I haven't fully considered and really need to do work on. And I almost didn't get to the end. So I wanted to give you the chance to lay that out. Look, man, I know we had more to cover. I'm sorry that I didn't keep the conversation going on a faster cadence, but I enjoy talking to you. You're welcome on anytime, and I hope you had a decent time.
Hey, I loved it. Like I've said before, your podcast is far and away my favorite, and it's an honor to be here and for you to let me rant about Nintendo or whatever it is. I always not only love listening to your shows, but love catching up and talking. And hey, I'd be glad to come back anytime you want me. So just let me know.
All right. Well, be careful what you wish for.
Always, brother.
All right. Have a good one.
Yeah, you too, buddy.